Discuss the three major roadblocks that people are facing when it comes to their retirement. These are the things that are keeping people up at night, that are building anxiety and stress, and more importantly, uncertainty when it comes to retirement. The first thing that we're going to dive into is let's get right to the point and get to the three concerns or three major roadblocks. The first major roadblock is people are concerned about volatility, the ups and downs of the market. It's almost like most people have to have their fingers crossed as they're going into retirement or in retirement. In fact, most people can't stomach the losses. And it's most people don't have the time, training, or temperament when it comes to managing their own assets. The second is frustration when it comes to receiving low rates of return. And lastly, people are worried about paying unnecessary taxes. Let's face it, you're not rewarded because you pay more taxes than your neighbor. So people are really concerned about taxes. And my question to you is, do you think taxes are going to go up in the future or going to go down based on the current state of the economy? So let's talk about roadblock number one, which is volatility. If you look at this diagram, it looks more like an EKG. It's, people are riding this roller coaster. It's up and down, up and down. You almost have to have your fingers crossed to make sure that you're to hope that you're on the upswing, but that's not a great strategy, right? So volatility, what it really means, it actually equals fear of loss. That's what's one of the major concerns is volatility. But what are the rules that Wall Street is teaching and the myths that they're actually teaching? So the first one is average rate of return. The second is the buy and hold myth. Number three is the market averages of 12, always 12%. And then lastly, the market always goes up. Have you heard of these before? I'm pretty sure and I'm pretty confident you've heard of this before. And these are myths, and we're going to dissect these myths so that you can actually, or we're going to examine them and break them apart so that you could take a look at them a little bit differently or have a different perspective, because chances are you've probably been playing by Wall Street's, rules. So the first one is let's take a look at average rates of return. So if year number one, you earned a 50% rate of return, and then year two, you went down 50%, it doesn't feel like you lost, right? It doesn't look like it, at least, because you're like, oh my gosh, well, I gained and then I lost, so it seems like I'm breaking even. Year three, you went up 50%. Year four, you went down 50%. So when you look at this number, it seems like it's zero. But when you take those percentages and again you add them up, it looks like it's zero, but here's the one thing I want you to really look at. Stop looking at the percentages. Percentages are great, cool, but look at your dollar. How much money have you put into it, and where is your dollar amount? Did it grow? Did it go down? So let's just assume that you actually put in $100,000 and you're number one. It went up 50%. You're now at $150,000. That's pretty awesome, right? But if you went down, you're number two, negative 50%. You're now at 75,000. You're number three. You went up 50% from that point because that's your real dollars. You're now at 112,500, and then you're number four. You went down negative 50%. You're actually now at 56,000. So no, absolutely not. It's not 0% average. What dollar amount are you at today? Your real return is actually negative 43.75%. So keep your eyes on the ball, as they say it in sports. Keep your eye on your money, because that's the truth. That's the truth of the story. So, of course, don't play by that rule. Keep your eyes on your money. The 12% rate of return myth. So the wild ride, investors never get off the roller coaster. So look at this again, same thing as I shared with you before in the other graph. From 1960 to 2010, this is the S&P 500 returns. If you follow this roller coaster, I mean, think about the stress of, I mean, isn't it kind of interesting that when the market goes up, most people are up, and when the market goes down, most people are down. Again, people are riding the roller coaster. They don't have the time, train, or temperament to manage their own assets. So I don't know if you want to get on that one. Market versus investor returns. The Dalbar Inc. has tracked investor behavior and its impact on returns. So for the past 20 years, investors have substantially underperformed the market. So what does that exactly mean? Obviously that, if they're trying to invest themselves or trying to manage assets themselves, they've actually underperformed what the market has done. So if you just track the S&P in the last 20 years, it's about 8 to 9%. This is a little outdated. So it's about 8 to 9% that it's actually averaged in the last 20 years. But when you look at investors, it's more close to 4% or so, or maybe even less than that in the last 20 years. So investors, technically, the rates of return have been about approximately 58% less than the actual market. So I always tell people, like, so why do you pay a professional money manager to help you lose your money? It doesn't seem so professional, right? It doesn't make any sense. And of course, they're always going to tell you to keep your money in because they get paid by managing assets. Every time they're buying and selling, guess what? They're making money. So of course, they're going to always want you to be in the market, and they're going to want to manage your assets because that's how they make money. But if you look at the actual returns that investors have done for their for people, not that great. They can't even keep up or keep pace with the S&P. So 12% rate of return myth again. Bloomberg actually says this, that the Dow plunged, this, remember this in 2011. And these are just reminders of history that you get, that you probably lived through or lived by, or you could remember, is the Dow plunges 634 points in the first trading day after the US downgrade for the biggest drop in 2 years. Over the next days, it rebounded 429 points and plunged 519 points and rallied 423 points. That's the lingo they'd like to use. Yeah, it rallied. You just literally went down 600 points. It starts going up and down, and then it rallies up 400 points. U.S. Today says only 4% of U.S. stock funds have beaten the actual performance of the S&P 500 over the last 10 years. Moneynews.com says hedge funds facing worst year since 1990. Many investors are running to the sidelines. This is December. I mean, I'm reminding you of the things that have happened, right? Because it seems like nowadays people are forgetting and people are excited again. They keep they're looking at the market. Everyone keeps saying the market's at a high, housing's at a high, but really, have most people recouped, what they lost in 2008 or from 2000 to 2003? So don't just get caught up with what the media is saying. Really, just again, look at your dollars. How is it working for you? And this is from US Today, saying that the average diversified US stock mutual fund has fallen 5.9% this year versus 1.4% loss for the S&P 500, which tracks. So out of 8,036 funds, 7,399 or 92% are showing losses. Again, majority, this is a huge piece of the pie. 92% have shown losses. This was 2011. That is tremendous. Think about it. Remember what I shared with you earlier. Now, if you notice, when the market's up, everyone seems to be up, but when the market's down, everyone seems to be down. Again, people are passive investors. They don't have the time, trainer temperament to manage their own accounts. So let's move on forward. This is real world right here, real life. From 2000 to 2003, the market went down 38%. But from 2004 to 2007, the market went up 83%. So Wall Street highlights this performance to lead you to believe that you would miss out if this massive gains had you not bought and held. Again, this is the manipulation. This is the game that they're playing. And this is, I hope you're not participating with this, because you need to do your homework, right? You need to understand what's going on. So if you had invested $100,000 on day one in 2000, by the end of 2003, your actual account balance would have been $62,000 or 38% down. All right. And then by 2007, your actual account would have actually grown, went up 83%. So now your new account balance is 113,460. When all is said and done, your average return over the last 7 years was actually a whopping 1.92%. What a roller coaster, right? Just to get a whopping 1.92%. You might as well have held it in a CD and not gone through this stress and roller coaster. But again, it's easier looking back, right? But most people are playing by Wall Street's rules. So let's look at a lost decade. These are 10 years of you losing money with this whole buy and hold strategy. It will always come back, right? Well, let's take a look. Let's look at this decade from January 1st to 1999 to December 31st, 2009. Again, this is his history right here. Boom. By the end of all of this, all that headache, and the individual started at $100,000, rode the roller coaster, and because of these losses, literally the person is at only $89,000. That's a loss of a decade. The most important thing I want you to look at is that we can't go back and regain time. Yeah, you can make more money, but think about the rate of return you would have to achieve just to recoup a loss of 38%, or a loss that happened in 2008. If you lost 40%, you would have to approximately gain the next year about 60 to 70% just to recoup that 40% loss in 1 year. I mean, that's nuts. So again, this is the buy and hold strategy or myth that Wall Street is teaching. But hang in there. Hey, guess what? The market always goes up. They're always telling us the market always goes up. But let's look at Japan now, the third, world's largest economy. In December 29, 1989, the Nikkei index peaked at 38,957. As of December 30th, 2011, the Nikkei was at this point. Now, again, I'm showing you history. This is 80% below its peak. Think about this. And even if the Nikkei has gone up slightly now, I mean, it depends. How old are you? Are you willing to go stomach through those losses? Can you afford to take those losses? What if you're already in retirement or about to retire? I want you to think about that, because that's what I want to sit in as you're watching this right now. So this is the buy and hold, but look where it started at. That's crazy. That's 20 years. That's a pretty substantial time for you to be able to stomach. I personally can't afford 20 years. I can't even afford 10 years to be stomaching losses. I don't think anyone wants to lose. So roadblock number 2 is the low rates of return. CD rates, lots of pain, but still no gain. According to Bankrate, CD yields, this was as of 2011, which started heading south for years and the economy began to buckle, went from bad to worse in 2011. But look at this. This is from January 26th, 2019. You could actually go to this site, fdic.gov, or you could go to bankrate.com to look at the actual national averages when it comes to CD rates. A 6-month right now is about 0.4%, less than half of a percent. A 1 year is a whopping 0.58%. Rate of return for a CD, and then a 5-year, and this is for you having at least a minimum of $100,000 in this type of CD to get a whopping 1.16%. I mean, if you were just to apply the rule of 72 and you took 1% divided into 72, that means it's going to take 72 years approximately to get your money to double. That's again, lots of pain, but still no gain. Now let's move on to taxes, and that's another huge concern, is paying unnecessary taxes. Tax potentially, actually, it's going to be the most powerful challenge you're facing when it comes to your investments. And so here's the way it works. You earn it, you get taxed. You spend it, you get taxed. You save it, you get taxed. You die, you get taxed. From birth to death, you're going to get taxed. So we're always going to have that partner with us, Uncle Sam, that's going to be, touching our money when it comes to taxes. And I'm all for paying taxes, but do you have to pay unnecessary taxes or pay more than your actual neighbor? Now let's look at the taxes in a different state. So if you're thinking, well, I'm in a different state where I'm not paying any state taxes. Well, look at your state currently. I'm currently in California, and California has one of the highest. It's at 13.3% as a federal tax margin. Now, some of the states don't have any, but I'm sure they make it up in other areas. But let's go ahead and dive into what historically have been the rates as a U.S. federal tax margin, income tax rates. So if you look at year 1913, it was 7%. In 1918, it was 77%. You could go through this. Look, it was at 94% in 1944. And then in the 1968, which is not too far back in history, or even in 71, it was 70% or more. In 2000, it went down to approximately 39.6%. And then today we're at 2019 at 37%. So if you look at what the average has been literally historically since 1913 to 2018, we're at approximately 59.1% average. But where are we today? At 37%. So do you think, I'm not going to answer this for you, but do you think that taxes might go up, especially with the deficit the U.S. is in, with the challenges that the Social Security are facing, not to mention Medicare? I mean, there's a lot we could talk about or even dive into, not for today's conversation, but what would you think? I personally would not be mortgaging out my retirement to say, hey, Uncle Sam, I'll pay you taxes later at whatever rate you want it to be. Now, you could do your homework on that. So what's the game plan? It's going to be a tailored solution for you. Those 3 major roadblocks that I discussed are things that are literally keeping people up at night. When it comes to volatility, getting really terrible rates of return at the bank. In fact, banks are charging fees instead of giving better rates. And then the last one is really just paying unnecessary taxes, not to mention people's fear of outliving their money. Number one, they have already enough stress of trying to get to their retirement. Number 2 is paying a ton in fees, because a lot of the programs nowadays have a lot of hidden fees, and then paying way too much in taxes. So there's a lot going on. It seems like, it could be overwhelming, right? But if you sit with a professional such as Difference Financial, then we're gonna create a strategy that's gonna be tailored to help you to face these 3 major concerns, or the concerns that you're facing. So there is a strategy that could do the following. What if I could show you a way that you can participate and have market-like returns and only participate with the upside up to a certain point, but with none of the negatives? Would that be of interest to you? Well, guess what? There are strategies that offer that where we eliminate or they eliminate completely the losses. So if the market went negative, guess what? You get a zero because you're not participating in one of the negatives. But if there's a positive return, let's just say 5%, well, you get the 5%. But let's just say there's an awesome year and it does say 20%. Well, they might limit you maybe up to 11% for the year. But it's a whole lot better than ever losing money because the biggest killers, one of the biggest killers is trying to recoup from those losses. The second is potentially better returns in the bank. Hands down, you could get better rates of return than the bank. It's just most people don't know what other options are available out there. And these are guaranteed rates that are backed up as well. The third is grow tax deferred. What if you could grow your money again tax deferred, no capital gains, and income tax free if you withdraw properly from these type of strategies? In some cases, you actually do it as a loan. Now, another topic for a different day, but there are strategies where you could have that. And then lastly, what if you could also have a program where it'd be tax-free death benefits to your beneficiaries? Pretty powerful, right? So if you would like to learn more and see if you could qualify for one of these strategies, then why don't you set up an appointment with the different financial professionals so that you could actually see if this is something you might qualify for. There's definitely strategies available. Again, it's about working with a group. It's going to bring a non-biased approach. It's going to bring you options, and it's going to tailor a strategy to fit your specific needs and goals. I hope that you got some value from this, and I hope it made you think. Go do some of your homework, but most importantly, set up a time for us to meet with you, even just a brief conversation over a phone, over a Zoom webinar type of meeting. Again, thank you, and have a great one.